I'm Pippa Malmgren, and I have been an advisor to M&G because I specialize in the risk to the portfolio and to prices that we can't quantify. So politics, policy, and geopolitics in particular, which in the current environment are very important. Policy and political pressures are having a significant impact on prices and on the anticipation of future price movements. And it's a global phenomena. For example, in Europe, we're right on the brink of hearing that Greece not only has now defaulted 3 times, the last haircut on their bonds came to a 21% haircut, but probably it's going to have to be bigger, more like 50 or maybe even 60%, and I'm not convinced that'll be the end of it either. And there's a worry that if the Europeans can't prevent that default, which it seems clear they cannot, then what are the implications for financial institutions and other sovereigns in Western Europe? So in that sense, I think politics and policy decisions are now central to the investment landscape. There's a lot of anticipation about a deal between the French and the Germans. And my sense is there is no deal between these two entities. There's a deep disagreement about who should pay for what and what the terms should be. Interestingly, our politicians, who I've just recently visited, they're saying, oh, well, the Europeans are in such trouble. Everybody's buying US dollars and US treasuries, so we have a reprieve. You know, they don't understand that that's not how this game works. We have heard from a number of European and American policymakers that if we allow these defaults in Western Europe to occur, which include not just sovereigns but banks, and we've just seen Dexia as one of the banks that has effectively gone bust, that this will lead to 10 years of a recession. Personally, I don't buy it. In addition to this idea that policymakers think we might have a recession for the next 10 years, we've also heard some pretty significant officials say some very bold things. Jean-Claude Trichet, the head of the European Central Bank, recently said this is the worst crisis in Europe since World War II. We've had Mervyn King say something very similar. He actually said this is the worst crisis ever. So this is a bold set of statements. Now, my personal view is that it's dangerous when policymakers start saying things like that because it just scares everybody. It doesn't scare me as a professional in the markets, but for your average person, that's a pretty daunting set of words to hear. So I don't see that it's helpful in any way. I also don't think it's correct. You always think the crisis you're in is the worst one that has ever been. And then you look back 3 years later. I mean, I actually recently heard a fund manager say to me, oh, well, you know, 2007 was a blip. A blip? Well, actually, in retrospect, it was. We must be careful about our inclination to exaggerate current events. I also don't think that what we're on the brink of here is anything like the 1930s. And that's partly because in the 1930s, government took control of everything. The price of dairy, the price of steel, the amount of production. I mean, literally it was a command control, almost Soviet communist style policy response. What we have today is the opposite. We have policymakers trying to control and being utterly unable to do so. Markets are getting the upper hand. Well, that means there's no comparison. What we're going to find is defaults usually lead to growth. That's the whole point, is you remove the debt burden and now you give oxygen to the opportunity to grow. Not only that, but I would argue that worldwide we're witnessing a kind of renegotiation of the social contract between citizens and their states. And you can see it in lots of different ways. You know, in Greece, you see the citizens saying, wait a minute, you know, you promised to let me retire at, you know, a young age. And the state saying, well, we can't keep the promise. So they've got to renegotiate that deal. Same thing in the United States. You know, the government promised to pay Social Security and now maybe they won't be able to. So we need to discuss what is the arrangement between me and the state. I think in China we see the same discussion as the public says, maybe I won't be rich before I get old. And if that's the case, then I want to have a conversation about how come all the wealth and the assets in my society are going to somebody else. And I would say this is the origin of the issue we had in the Middle East and why we saw the overthrow of certain governments. Overall, I think that once you reestablish what's the new arrangement between citizens and their state, you actually clear the decks and create a foundation for growth. And the reference points we should think of are not Japan and its lost decade to deflation, because they decided to pay the debt. They didn't default. Once you default, that scenario goes away, and I think a better reference point will be India after the Soviet Union imploded and ceased to exist and forced India to become a market economy participant. Or Sweden after their banking crisis. They hit the wall, and from then they began to grow and restructure. So I think we're about to see a period of European history where for the first time in maybe 30 years, there's going to be some oxygen for entrepreneurs, and that's a good thing. Well, civil unrest is obviously a very scary phrase and quite unnerving to people, but the fact is we now have it. We have seen it in the Middle East, and while it has been disruptive, I must say people have begun to realize that the changes that have been brought about are probably for the better in general. We have a new relationship between citizens and their state, which was going to distribute the wealth and the power in those societies more fairly than in the past. In Europe, we're seeing civil unrest in the form of the Greeks protesting against austerity. I think we're going to see more of that in other southern European countries. I think we're seeing civil unrest in the United States. You can see it obviously in the form of the civil protests against Wall Street. Very interesting that the bankers, for example, thought that the so-called Frank Dodd legislation basically gave them a free pass, and therefore there would be no constraints on banking. And it turns out that Michael Moore and Susan Sarandon are the ones who are going to constrain the banking sector and say, no, you cannot take grandma's savings and gamble it in such a way that the whole society has to pay the price for years to come. Well, that resolution of the relative power in that society is underway. So civil unrest is also in play in China, and we're seeing the Chinese leadership having to work pretty hard to keep it under control. That's a function also of some of the pressures in that society as people begin to realize maybe I won't be rich before I get old. And if that's the case, what is the deal that I signed up for, and what is it that I expect in terms of the distribution of the wealth and the power and the assets in the country I live in? So overall, I do expect more civil unrest, but in the context of creating a new foundation, a new landscape, or one might even say a new deal. On the one hand, I talk about civil unrest and the renegotiation of the social contract, and I would go further and say I think we're going to have more inflation, and I think that governments are going to keep spraying liquidity around and offering free money in various ways. That makes the risk of inflation even higher. Oil at 70 or 75 is not exactly easy for households or companies, and from that point I expect those prices to rise again. So that's the grim side of it, and the squeeze that creates on human beings is very powerful, which is why we see people respond. For example, the riots we had in London, where the young, socially networked, unemployed respond to the pain that they're feeling. But having said all that, I also think that the investment opportunities that come out of such a landscape are quite formidable. I still think that strong brands are really good things to own because they have the capacity to both manage the rising input costs, but also pass on the higher cost to their customer. They can do this also by innovating with their products, which I think there's going to be a lot of. By the way, there's going to be innovation in politics as well. As we chuck out the old guys and bring in the new guys, that equals innovation. So I think there's a lot of innovation on the landscape. Not only that, but you can actually see companies raising prices and beginning to not get an adverse response to that. So Kimberly-Clark, Syngenta, the seed company, McDonald's, I mean, you can really see that actually they can get away with a price hike here and there. So I like genuine unimpaired cash flows, and they do exist around brands, and they exist around all sorts of different sectors. I think the hard thing is to identify them. That's where the sweat and the effort needs to be made. That's where you need people with skills to suss that out on your behalf. But the idea that that doesn't exist, or it only exists in one country, I think is wrong. That absolutely we are on the brink of some fabulous new innovation and investment opportunities around that innovation.